Hold up, let me ask you something that might shake the ground beneath you. Have you ever felt like the stock market is a giant, bewildering casino? A place where Wall Street types speak a secret language, raking in millions while you're stuck on the outside, watching others either strike gold or crash and burn? You're not alone. Millions feel this way, and it's no accident. The media paints it as chaos, with headlines screaming about crashes or hyping instant riches that are more myth than reality. It's designed to keep you out, confused, and afraid. But today, we're smashing that illusion. Over the next while, I'm going to pull the stock market out of the fog, strip away the jargon, and hand you the map to turn this so-called casino into your financial liberation. Stay with me, this could be the moment you take control. You wake up, grind through the day, chase paychecks, dodge bills, and pray you're not the next one laid off. You've been told, work harder, save more, live frugally, like it's a golden ticket to freedom. But the bills pile up, the rent skyrockets, and the system feels rigged against you. Sound familiar? It's because you're playing a game you didn't sign up for, a financial squid game where the house always wins. The stock market? To most, it's just another table in that casino, a place for the elite to gamble while you watch. But what if I told you it's not a gamble, it's a tool, and the only reason it feels like a trap is because they've hidden the rules from you? Let's rip the mask off. The stock market isn't a mysterious beast, it's a marketplace, a massive, ever-running supermarket. But instead of buying apples or TVs, you're buying tiny pieces of companies. These pieces are called stocks or shares, and owning them means you're a co-owner of a real business. This isn't some abstract number on a screen, it's a factory, a team, a product you might use every day. If Apple makes an iPhone you love, or Starbucks brews your morning coffee, and those companies thrive, you benefit as an owner. Take Jane, a cashier from Texas. She bought 20 shares of Starbucks for $1,500. When the company grew, her shares hit $2,000, a $500 gain she never dreamed of from her $12 an hour job. Why do companies sell these shares? They need cash to grow. Imagine a business wanting to build a new factory, hire brilliant minds, or launch a game-changing product. Instead of drowning in bank loans with crushing interest, they sell ownership slices to investors. This debut, called an initial public offering, IPO, is like a company's coming out party on the public stage. Think of Tesla's 2010 IPO, raising $226 million to fuel its electric revolution. Investors got in early, and those who held on saw their stakes soar. Once shares hit the market, on exchanges like the New York Stock Exchange, NYSE, or NASDAQ, you and I can buy or sell them, creating a dynamic arena where millions of trades happen daily. But how do you get in? The NYSE and NASDAQ aren't just grand buildings, they're tech-powered hubs matching buyers and sellers. You can't walk in and trade directly, that's where brokers come in. Companies like Charles Schwab, Robinhood, or Interactive Brokers act as your gateway. Open an account, deposit funds, and use their platform to buy or sell. There's a primary market, IPOs, where companies raise cash, and a secondary market, where you trade with other investors. When you buy Apple stock today, you're not dealing with Apple, you're trading with another player. It's a living, breathing ecosystem, and understanding it is your first power move. Now, why do prices swing wildly? Here's the gut punch: the market isn't just about logic, it's driven by emotion. Fear and greed rule the short term. Greed pushes buyers in when stocks soar, hoping for more. Fear triggers sell-offs when prices drop, sparking panic. Remember the 2020 COVID crash? The S&P 500 plummeted 34% in weeks as fear gripped the world. But those who held, or bought during the dip, saw a 67% rebound by 2021. It's herd mentality at its rawest, and it's why most lose when they react instead of think. Rumors fuel the fire. Imagine a whisper that Tesla's launching a battery to end fossil fuels. Investors rush in, demand spikes, and the stock soars, sometimes creating bubbles. If the news flops, panic sells crash it back down. This volatility is the market's heartbeat, and it's where emotions cost you unless you stay steady. Long term, though, prices align with fundamentals, revenue, profits, debt levels, management quality, and competitive edges. A company like Coca-Cola, with its global brand, holds value through thick and thin, while a startup might crash if its tech fails. Broader forces shape the game too. Interest rates rise, borrowing costs soar, and stocks dip as bonds look safer. Inflation erodes your dollar's power, hitting profits and prices. Geopolitical shocks, like the 2022 Russia-Ukraine conflict, spark uncertainty, tanking markets. Tech breakthroughs, like AI in 2023, ignite booms. Regulations can make or break industries. Think marijuana stocks soaring with legalization. It's a complex dance, but knowledge is your shield. Stocks come in flavors. Growth stocks, like young tech firms, promise big gains but swing wildly. Think Nvidia before its AI surge. Value stocks, like steady General Motors, offer stability and dividends. Blue chip giants like Johnson & Johnson pay reliable dividends, while small caps under $2 billion risk more but can explode. Market cap, large, $10B plus, mid, $210B, small, less than $2 billion, guides your risk. Dividend stocks, like Procter & Gamble, give steady income. Knowing these types lets you pick your battlefield. Risk is the elephant in the room. People fear losing money, but risk is uncertainty, not guaranteed loss. Volatility, price swings, is normal, you only lose if you sell at a dip. True risk is a company going bust, like Enron in 2001, wiping out $74 billion. Manage it with diversification, spread across industries, not just one stock. Long-term investing smooths the ride. The S&P 500 averaged 10% annual returns over 50 years, surviving crashes, wars, and recessions. Time beats timing every time. So, how do you win? Not by gambling, but by investing. Forget day trading's hype, catching peaks or troughs is a fool's errand. Instead, understand what you own. Research companies, do you get their product? Is their future bright? Be consistent with dollar cost averaging, invest $50 monthly, buying more when prices dip, less when they rise. Let compound interest work its magic. Start with $1,000 at 7%, in 30 years, it's $7,600. Add $100 monthly, and it hits $126,000. Einstein called it the eighth wonder. Harness it early. Getting started is simpler than you think. You don't need a fortune, $50 can kick it off. Open a brokerage account online in 15 minutes with Schwab or Fidelity. Start with index funds or ETFs, like the S&P 500 ETF, tracks 500 top firms, for instant diversification and low fees, average 7 to 8% returns historically. Automate contributions, pay yourself first. But here's the reality check, 80% of day traders lose money, per a 2021 second study. Patience, not panic, wins. Alright, let's pause, drop a comment. What's the one thing holding you back from investing? Fear? Confusion? Let's tackle it together. And if this is lighting a fire in you, hit that subscribe button, as Barrick is your guide to mastering this game. We're just starting. Next, we'll dive into ETFs, stock analysis, risk protection, and building your first portfolio. The stock market isn't a casino, it's your engine to wealth. Understand it, and you're no longer a player, you're the house. Share this with someone lost in the fog, they need this. Take that first step today. See you next time. This video is for educational purposes only and does not constitute financial advice. Always consult a licensed financial advisor before making any investment decisions.